All right, why don't we get started? So my name is Mark Lamonica. I look after the individual investor team for Morningstar here in Australia. And today we're going to talk about commodities, and also sorry about the bad camera, but Will, who is our videographer, is unfortunately out today. His childhood dog died, which is very sad. And so the other thing about Will being out is we are a little bit delayed with getting those recordings up on YouTube, but he'll be back in tomorrow, so hopefully he can get through those. But this will be recorded. It will go on YouTube. I just don't know exactly when. But anyway, a couple of housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, you can get a copy of our FAQ from our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. So obviously the standard, you should listen to our podcast and follow us on Instagram. Also, our conference, if you'd like to join the wait list, it is, as you can see, Thursday, 13th of October in Sydney. Also will be available digitally if you're interested in that. So if you sign up for the wait list, you'll get an offer for our cheapest tickets, probably in about a week and a half at this point. So sign up to that, and let's talk about investing in commodities. Okay, so we're going to cover a couple different things. We'll do some definitional, sort of foundational information. We'll talk about what's going on with commodities right now. We'll look at where you may be exposed to commodities just as an investor in Australia. And then we'll look at Australian shares. I kind of limited it to Australian shares, and what our analysts think about them at a high level. So that's the plan for today. So what is a commodity? So you guys can obviously read, but at the end of the day, a commodity is something that that basically the market treats as standard no matter who produces them. So generally when we talk about investing from a commodity perspective, we are looking at iron ore, coal, copper, and oil as the main commodities, but then there are a lot of other ones as well, a lot of other metals. We've heard a lot about lithium recently, nickel, things like that especially go into batteries, which we talk about a lot because of electric vehicles. Now, given the attributes of commodities, we talk a lot at Morningstar about economic moats. So an economic moat, of course, is a sustainable competitive advantage. And we want to buy companies that have economic moats because, of course, that means they're able to fend off competition, which is good for us as shareholders. So it means they can earn higher returns on invested capital, so capital that they invest in their company. And it also means that they are able to maintain strong margins. Well, this is very different with commodity companies. So generally speaking, a commodity producer is a price taker. So a price taker, of course, is somebody who takes whatever price is out in the market. And in the case of commodities, there is a set price, of course, that they trade for, and those prices are transparent, and we can see them. Of course, we see that a lot in Australia, looking at the iron ore price. We hear about it a lot, especially if we're driving around and buying petrol, we hear about the oil price and different things like that. So remember, they're price takers. In general, a price taker is not a company that has a sustainable competitive advantage. What we would see from companies that do have moats or sustainable competitive advantages, we would see them as price makers, meaning they have pricing control. And they have pricing control, of course, because of some of those attributes that lead to them having a moat. So a simple example that we talked about actually on Instagram the other day is Apple. So Apple, we believe, has a moat. We believe it has a moat because it is a company that has there are high switching costs from consumers, so it's very difficult once you are an iPhone customer to switch away from it. And that's because they get their tentacles into you in lots of different ways. So of course they have a bunch of services, whether that's apps that you purchase, whether it's Apple Music. They have a lot of or iCloud and iCloud. They also have a lot of devices you get that sort of build out this ecosystem. A watch, AirPods, etc. And so that's an example of consumers not wanting to switch. And that gives them the ability to, of course, maintain market share and at the same time maintain pricing levels and potentially raise their prices. And we see this in surveys. There are surveys that 90% of iPhone customers say their next phone will be an iPhone, right? That's very good for a company. Now, when we look at companies that produce commodities, it's kind of the opposite, right? Because they're a commodity, the very nature of them being a commodity means I don't really care who I buy it from. So, in the example of oil, do I really care if I buy oil from ExxonMobil or Woodside or Chevron? No, I don't, right? Because it is, of course, a commodity. So the only moat source, and when we go through, we'll look at the different companies we cover in Australia, and you'll see that the vast majority of them do not have moats. And the only moat source that really applies, and there's 5 different moat sources that Morningstar looks at, the only one that really applies is the ability to produce and deliver that resource at a lower price point. So there are kind of 2 different things we can think about here. So obviously from a production perspective, it is easier or harder to extract these commodities from the ground, right? We've heard a lot about Saudi Arabia and how easy it is for them to get oil versus if I have to put a platform in the North Sea and drill miles and miles down through the water. So that's an example of differences in the cost that it takes to extract a commodity. And the other thing, of course, is location. So if there was a giant iron ore find in China, who consumes most of the iron ore, that would be very beneficial, of course, to have that because the transportation costs would be a lot lower than digging it out of Western Australia and putting it on a ship and sending it up to China. So really what we're looking at is cost advantage. Sorry, I skipped ahead. What we're looking at is cost advantage. So cost advantage is, as I said, the ability to extract things for cheaper, and that can be a moat source for commodity producers. The other thing I would say, and we'll talk about cyclicality in a little bit, but over time, commodities have gone through these boom and bust cycles. And we'll look over on the right as an example where you can see during different time frames, we've had big gains. So we're looking at the Bloomberg Commodities Total Return Index through February. So things have changed a little bit through February, which I'll get to in a second. But over time, we saw these huge swings. And the reason for this is that with most commodities, it does take a lot of investment to develop a mine, for example, or to develop a new oil field. And so what generally happens is higher prices in a commodity will lead to new investment. That new investment will take a while to bring a new mine online or to bring a new oil field online. That will take a while. And then, of course, all of a sudden, there's this huge flood of new production, which lowers prices again. And that's why we keep seeing these different cycles. We'll talk about other things that impact commodity prices as well. All right. We're going to talk a little bit about the current environment for commodities. And of course, that is a big Chinese flag because it's hard to talk about commodities, especially iron ore, but also a lot of the metals without talking about China and going back and looking at what has happened in China over the past 20, 30, 40 years. And a couple of things have happened. So number one, we've had sort of massive urbanization in China. So if you go back to 1980, this is my fun fact, it's not that fun, but if you go back to 1980, 20% of the Chinese population lived in a city. In 2022, it's just under 65%. So we had this huge migration, and for those that have been paying attention to anything at all and know anything at all, there's a lot of people in China. So we've had this huge migration from pretty rural population into the cities. So of course those cities had to be built. Those cities being built involves a lot of steel, and of course iron ore is a main ingredient into steel. So we've had all this urbanization. It is slowing and almost stopping at this point, given that huge swing, 45% of the population shifting from rural to urban. The other thing, of course, is infrastructure to support a growing population, to support a population moving into cities, and frankly, just to keep the economy going. There's been really, really heavy infrastructure spending in China. But at this point, at a per capita basis, China has reached Western levels. So while there still will be infrastructure spending, and there obviously will still be development of infrastructure, there isn't this huge cyclical catch-up, which is what we've seen in China. So that's another factor we need to look at. So a lot of people are questioning, okay, as we start to see demand, and really, if we look at iron ore, it is China that is setting the price and setting the market for it. So as we start to see that demand slowing in China, what is that going to do to iron ore prices, for example? The other thing that, of course, we need to look at is what's going on with inflation. So if we go back here, we look at a couple things. During COVID, we saw, particularly with oil, but also with other commodities, we saw a huge fall in demand and then, of course, price as well. We've seen that bounce back as economies have come out of COVID. And the other thing, of course, is we've seen inflation increase. So what does inflation do? Well, a lot of people use commodities as a hedge for inflation. So, of course, commodities become very popular in inflationary environments, and commodities also, it's a little bit cyclical here, not the other way we're about to talk about. Also, of course, higher commodity prices drive inflation. So we saw a lot of that yesterday when the RBA came out, or not the RBA, but when Australia reported inflation numbers. Remember, Australia is pretty far behind for some reason. It's the only developed country in the world that reports inflation quarterly and also reports it very slowly compared to other countries. So yes, a lot of this inflation is pretty far behind us, and we get very late readings. But of course, a lot of this has been driven by petrol prices going up. It's been driven by, of course, the increases in the cost to build almost anything, and then some other factors as well. But people, of course, invest in commodities as an inflation hedge. Now, what's important to look at, this Vanguard research right here that I quote. So it says that over the last decade, commodities rose by 7 to 9% for every 1% of unexpected inflation. Now, it's important to look at that and remember unexpected inflation is the difference between projected and realized inflation. So while we are still in a inflationary environment, inflation has not started to come down anywhere, there are very high expectations for inflation now. So just remember, it's the expectations that are what initially drive those commodity prices. So remember, we kept hearing over and over again that inflation was transitory. It was transitory. It was going to go up to 4% and then stop there. Well, it didn't. Right. So it's that unexpected as the market starts to change those expectations that really drove commodities up in price. And, at this point, even if we look at the RBA, who has a pretty terrible track record of predicting anything, but if we look at the RBA, the expectation is inflation will continue to rise, right? It was 6.1% in the quarter that we just received a report on yesterday. But Philip Lowe has said he expects it to be 7% by the end of the year. So just remember, those are the expectations. So it's not the actual inflation. So that's one thing to look at. And what we've seen is we've seen a lot of commodity prices come down. So what isn't in this chart right here is what has happened since February, since it's a little dated. So there is certainly not about expectation, but the market fears that the central bank moves are going to push the economy, push global economies into recession. And commodities typically perform very, very poorly in recessions. And that is because, of course, they're very cyclical. So cyclical, when we look at different companies, different industries, cyclical industries and companies follow the economic cycle. They do very well when the economy is doing well. And they do very poorly, of course, when the economy is doing poorly. And we just think about that a little bit. What that actually means is that, a lot of commodities, a lot of the sort of basic material commodities are inputs into construction. Construction typically is pretty cyclical itself, right? People are investing in new buildings or going out and building new houses. Everything like that when the economy is doing pretty well, when they're comfortable with it. And then, of course, those projects get brought offline when the economy is doing poorly or they get delayed. And that, of course, is going to impact commodities. Same thing with oil, of course. So if we look at oil, and once again, we're sort of looking at the margin here, right? In oil, that, more people are using energy when the economy is doing well in almost every way. So those are these two big questions for us when we're looking short term in terms of commodity prices. Yeah, has it peaked, and will increases in interest rate drive the economy into a recession? And of course, we have supply shocks. And if we look back, if we go back to the 70s, of course, so the oil embargo, that certainly was a supply shock that drove up prices, drove up inflation. One of the things that contributed to this, of course, was the war in Ukraine. So we hear almost every day about what's going on with natural gas going into Europe. We, of course, have a lot of countries that are no longer doing business with Russia. And that, of course, is a big question. And Russia, of course, does a lot more than just oil. So they're a major exporter of nickel, aluminum or aluminium, oil, thermal coal. A lot of commodities come out of Russia. So, of course, that has been a bit of a supply shock, which has driven up prices. So, of course, if things go very well in the war in Ukraine, and it is either brought to a conclusion, there is some sort of peace deal, then, of course, that would, in theory, open up more supply. And then I just put the Middle East on there because something can always happen in the Middle East, but that's another consideration as well. All right, so Lisa's asking a couple of good questions. First of all, Lisa, I do believe Apple does pay a dividend, so you should check that. But Lisa also asks, can individual investors buy commodities on the ASX? So we will get to that. We will get to how you can invest in commodities. But one other thing to remember, and this certainly goes into this sort of boom and bust cycle that we've been talking about, is that as a commodity producer, as a company that produces it, you, of course, are depleting your reserves that you have every single day. And so that's why we're very focused, of course, on those investments in new supply, because, at the end of the day, there hasn't been a lot of investment recently, which is also creating tighter conditions for commodities. So we'll see if that changes. We'll see if these prices stay up enough so that people start investing again. But that's something to think about. And then one other thing, depending upon sort of what you're comfortable investing in, is ESG considerations. So ESG considerations are certainly something that that many people ask about. And what it's really done to a lot of these, particularly around coal, oil as well, is that banks, investors, all sorts of people are refusing to lend to these companies, meaning that's also going to constrain future supply and drive prices up. Right? If you're unable to go out, as I said, it's very expensive to develop a new mine, for example. So if you're unable to source capital, and it takes a lot of it to go out there and create that mine, that could potentially throw off this boom and bust cycle. So like coal has done very well from a price perspective, but a lot of people out there developing new coal mines. It certainly is happening, but it's going to be harder and harder because there's issues with financing. All right, so Australia, let's talk about how do you get exposure to commodities. So one of the things about commodities is generally there's a very high correlation between resource companies, so the companies that produce those commodities, and commodity prices. And what that really, of course, has to do with, once again, is the fact that these companies are price takers. So they don't have very much control over the price they're going to get for any of these commodities. So they've got a couple different choices. They can continue to produce stuff if prices fall. They can continue to produce the commodity and sell it for a lower price. Well, that of course is going to dip their revenue. Not a great thing. The other thing, of course, they can do is they can decide, okay, well, we have, not a lot of reserves, and maybe the best thing to do is not keep selling the same volume, hoping that maybe eventually that would drive up the prices of the commodity. We see this all the time with OPEC, right? With the oil cartel, that's basically their strategy, that they're releasing and constraining supply depending upon what's happening in those different cycles. But yeah, one thing to be aware of is that investing in companies that produce commodities generally will give you a pretty good correlation with the actual prices. The other thing you can do, Lisa, which is difficult to do, but I guess possible, is of course commodities trade on exchanges. That's how we set these global prices. And then these global prices, for whatever standard they're talking about, then depending upon the quality, will be priced above or below that price. So because they trade on exchanges, you can invest in that. That, of course, is a little more tricky to do, but you can go out there and, of course, buy futures on commodities. And I think there's some derivative type, well, futures are derivative, but I think there are some products with derivatives in it you can buy as well. But you're generally going to get pretty good correlation if you just buy the resource company. All right. Now, as Australian investors, and as probably is not a surprise to anyone, you are likely overexposed to commodities. So if you are like the average Australian and exhibit home bias, meaning that you are going to put a disproportional amount of money into the Australian market, and if you are buying certainly any index product that tracks any of the ASX indexes, so I put in the ASX 300 here, but the 200, given sort of market cap weightings, is pretty similar. You're pretty exposed to commodities. Now, commodities generally fall, commodity producers fall into two different categories on here. So they fall into basic materials. So basic materials is where you're going to get basically the iron ore in Australia, like a lot of this is BHP, Rio, Fortescue, etc. You'd also get any of the sort of metal producers as well, or metal miners. And then, of course, down here in energy. So once again, there are companies in that energy sector that are less exposed to the actual price, but that's also where you'll find all of the, explorers and producers, right? So the companies that go out there and find oil or natural gas and then produce it. So looking at these two categories, you can see basic materials in the MSCI Global World Index. So that is all the share markets around the world in developed markets. You're getting 3.67%. I can speak and read. If we look at the S&P ASX 300, we've got only almost 23% in basic materials. So just investing in an index fund in Australia, you are way more exposed to basic materials than you would be on a global basis. Same thing with energy. There's more, less pronounced, but a bigger exposure as well. So just remember that you might be very exposed to begin with, and what I always say about the Australian market is very concentrated in two different sectors: financial services, which is primarily the banks that are in there, and basic materials. So if you start to get into the situation, which I know a lot of people do, where you, of course, say, all right, well, I'm going to buy the index because I've been told that's the right thing to do, but I might add a couple shares to it as well. The banks are really popular, like BHP is a great company. All of a sudden you can be very exposed, right? That's just doubling up your exposure. So just something to think about. All right, so let's talk about some companies right now. And a couple things, Morningstar recently has come out and cut sort of what we call mid-cycle prices, we believe, that a lot of commodities are going to sell for. So if you are an analyst who is, going out and analyzing one of these companies, at the end of the day, the huge input into that is what you believe the long-term price of different commodities will be. So if you're ever reading a report on any of these companies, go find where our analysts or any other analysts that are covering them, go find where they talk about what they think the pricing will be and why. So we did recently cut, our analysts did recently cut sort of fairly significantly for iron ore, what sort of that mid-cycle price is. So what we're doing is we're looking out a couple of years for that, which will of course drive the expectations for what those prices are, will of course sort of drive what people think about those shares. So that's something you can go read up on in our analyst report. All right, so what I did is I just listed these. I'm not certainly going to go through them. I will point out a couple things. Of all of the companies that we cover here in Australia, we've got one moat only. And something to remember, that you don't see a lot of moats with commodity prices. What you're really doing is looking at, of course, as price takers, you're looking at where that price is going to be. But you can see there are certainly some opportunities around basically oil and coal at the end of the day, which is where our analysts do see. So price to fair value, we're looking at the price versus what our analysts believe the company is worth. So anything under 1, right? If the price and the fair value were the same, so that would be 1. Anything below 1, we believe is undervalued. Anything over 1, we believe is overvalued. So in this case, if we look at Fortescue, 1.25, so that means we believe that Fortescue is 25% overvalued. And then if we go look at Whitehaven Coal, for example, we believe it is 30% undervalued. So that's how you read the price to fair value. And then the other thing I would add is, some of these giants, basically Rio Tinto and BHP, so they are diversified. Now, they've been changing around a little bit, trying to get out of the coal business, get out of the oil business, but they're still more diversified than some of these pure play. So if you have a very specific thought on iron ore, that could be an opportunity to go for one of the pure plays versus something that's more diversified. And the only thing I would say about Fortescue here is that, generally their iron ore, their iron ore is lower quality. So they, of course, are going to get a discount on what iron ore is trading for. So something else to think about. All right, we've got a couple questions. That was very fast. We did that in a half hour. All right, so Brenda's making a comment about zinc and tin, saying that stockpiles are at 100-year lows. I thought the law of economics say prices should rise quite significantly. What are your thoughts around why the prices are trading at 12-month lows? So this is certainly a case where I would defer to our analysts. I do not know exactly what their zinc and tin forecasts are, but if you send me an email, I can get that for you. If you send me an email to mark.lamonica1@morningstar.com, I can get you there, get you a description of why they think they are trading at 12-month lows, what they think is causing that, and where they think the prices are going to go. But I am sorry, I am not a zinc and tin expert, or maybe anything else. All right, so lithium is an interesting one. So we've got a question. Is lithium considered a commodity at the moment? It's not traded openly on any exchange. Yeah, definitely lithium is a commodity. Lithium is something that we're hearing a lot about. And once again, the same notion, right? That like wherever you dig up lithium, there's really no way to differentiate it. Sure, there's like quality indicators around anything you find, but yeah, no, it's definitely considered a commodity. We've heard a lot about lithium, and we've heard a lot about lithium related to, of course, batteries. And sort of the thesis goes very simply that, okay, so what is one of the big sort of structural shifts that we're going through globally is we are obviously trying to lower our reliance on carbon. And how do we do that? Well, one great way to do it is, of course, electric vehicles. Electric vehicles run on batteries. What goes into batteries? Lithium, nickel, a bunch of other stuff. So that is sort of certainly the thesis around lithium. The only thing I would say is, and this should come as no surprise if you listened to me say this before, beware of things that quote unquote everyone knows and are generally widely accepted, because of course that means it's already priced into the market. So, I would suggest the real play for lithium would have been before everyone just decided that this was 100% going to happen. So that's one thing I would say. The other thing I would say is, once again, remember with commodities, like a lot of these, of course, they go through these boom and bust cycles. So all of these, crazy lithium companies that people are talking about on the chat boards, a lot of them aren't even in production right now. And so what does that tell you? It tells you that these companies are out there raising a bunch of money to go increase production of lithium. And from what I've read, at least, lithium is not exactly as rare as we think it is. So all it takes, and there's actually, walking behind me, that's Matt Hodge. He runs our equity research team, and he covers a lot of these companies. So there you go. Yeah, so the only point I'd say about lithium is everyone knows this. If all this money is getting invested in lithium, then we're probably going to see supply go up a lot. And that, of course, will impact prices. The other thing I'd say is don't forget about innovation, right? That's the other way that we as humans respond to high prices. And, one of the examples, of course, is if we go out there and look in the oil sector, we kind of looked at what happened with oil up until kind of that 2020 giant drop that we had around COVID. So, with oil, oil prices, and let me go back to these slides. It's certainly more interesting to look at than me. When we go back and look at this Bloomberg, if we go back and look at this Bloomberg index, we had these huge run-ups in commodity prices. If you remember back to that time, that's when we were going to run out of oil, right? You kept hearing about peak oil, peak oil, peak oil. And that, of course, is when fracking started. So somebody decided, okay, well, here's a different way that I can actually extract this. And I don't have to deal with, and this, of course, was after 9/11, I don't have to go deal with governments in the Middle East. I can just do this in the US, and the US became the world's largest oil producer, right? Nobody thought that was possible. The US had not been the world's largest oil producer for a very long time. So all I would say is be wary about the impact of higher prices, especially in a situation where we have everybody very fixated on something that will happen. And what will happen, of course, is electric vehicle sales will go through the roof, and that will drive iron ore up, drive lithium up. It might. I'm just saying it could be baked into the market. All right, we've got a request for Matt to cover two other companies. I will let him know. And then we have a good joke from Lisa about how Matt Hodge was the webinar's quickest guest. So today we had a funny story about Matt Hodge. Today we had some sort of international day for lunch, and everyone made food. And as an Australian, Matt made pies. And he made a bunch of little pies, and then he said it was midnight and he was getting sick of doing it, so he made big pies because they're easier to make. Anyway, it's my Matt Hodge story. I think we've got one more question, hopefully about food. All right, zinc is trading at 1/16 of lithium, and the new zinc ion batteries use water as electrolyte, which fundamentally prevents battery ignition. These are going to be the new batteries of choice. Okay, so one thing I will say is here's a perfect example. So this is a perfect example, perhaps, of looking at what it costs to produce a battery and coming up with a new technology. So this is what we all have to be very wary of when we are investing. And that is what Brandon said. I don't know any of that. I'm just reading it out. So do your homework on that. Okay, good. Good question from Lisa. She goes, as electric vehicle manufacturing increases, are overseas vehicle companies a worthy investment? All right, well, it's an interesting question. So a couple things that I would say is a lot of the electric vehicle companies And sort of we can use Tesla as sort of their the poster child of this. Like, a lot of them are trading at pretty high valuation levels and have very high expectations. And a lot of them are getting classified almost as like technology companies in people's mind, right? When you go out there and see all these companies of tomorrow, we're talking about a lot of technology companies. And then of course we're talking about some of these electric vehicle companies. But remember, this is not a company of tomorrow. This is an old school manufacturing company, where it takes a ton of capital in order to increase demand. And that's what we've seen with Tesla, right? We have seen them spend a ton of money. And for instance, that's why they don't pay a dividend. That's why they are not cash flow positive. Just remember that. I mean, I think people get very caught up, and yes, the car is cool and the car uses technology, but almost everything uses technology now, right? That doesn't make it a technology company. At the end of the day, whether they are building an internal combustion engine or there's an electrical vehicle, they are building a car. Building a car takes a lot of effort, takes a lot of raw materials going into that. This isn't a couple coders sitting in a room and then selling their product to a billion people. So that's the only thing I would say about that. The other thing I would say is, I think that'll be interesting to see how everything shakes out, right? Everyone sort of decided Tesla is the winner, but there's a lot of other people, a lot of companies that have been making cars for a very long time that are also investing heavily in those electric vehicles. And that competition generally does not do good things for investors, right? So this is where we do think, Morningstar thinks Tesla has a narrow moat because of their brand name and everything else. But just think about all these other car companies putting all this money into electric vehicles. Just be careful about competition. All right, so we've got a question from Eric. So what category does agriculture fit into? I guess sort of my answer to that would be, it depends what you're talking about. So certainly things that are grown, whether it's bushels of corn or soybeans or anything else, we'd certainly consider a commodity. Now, it's very difficult for us as investors to sort of access that, right? Although that is a commodity, unless you're going out there and trading on a futures exchange. The other side, of course, of investing in agriculture is land. And you can certainly do that. I would classify that more as something that would fall into real estate, certainly a very different type of real estate. But yeah, I think land is certainly sort of the play that we would have, and the land is certainly not a commodity at the end of the day, right? Like, you're investing in a factory that's creating these commodities, not what's actually getting pulled out. Like, nobody's sitting there looking at BHP thinking, oh, they own some land. Well, yeah, that's great, but what matters is they're getting out of it. I think sort of the play in agriculture is the land. And there's a company, in Australia, what's it called? Rural Funds Group, maybe? The ticker's RFF. That's an example. That's a company that just owns a bunch of land. They lease it out to farmers who grow things on it. So they own land and they own water rights. So that's sort of a play around agriculture, although it is a lot harder. Well, there's a lot fewer opportunities, I think, around other commodities. The other thing that is sort of similar is like timber. So timberland, not like the wrapper or the boots, but literally land you grow timber on. That's something that was and I think still is a very popular investment. A lot of the endowments and like large university endowments purchase timberland. And there were a lot of publicly traded companies that own timber, but I think a lot of them have been swallowed up and sort of purchased by like institutional investors, whether it's pension funds or endowments. It's the most I've ever said timberland. All right. So I think we're going to call it quits there a little bit early. But anyway, thank you guys for joining. Thank you for your patience with how long it takes to get the recordings up. And if you have any questions about zinc and tin or other things, email me, and in that case, I'll go find someone that can answer it. So thank you guys for joining.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.